So you want to review what you thought was going to happen on the weekly candle, go revisit that. And here's something also you want to do. You need to have a pen or pencil, some kind of writing instrument, and a pad next to you while you're trading. Because on that piece of paper or that pad, you have your weekly analysis, what you think it's likely to draw to. Because here's the benefit of doing that. If you do not have the expectation of where that weekly chart may be reaching for, you might get completely out of a position that's running right for that and leave 30, 40 handles if you're in S&P, or 80 pips in some instances on a Forex trade, because you just felt like it was time for you to get out and you abandoned where you thought that that weekly candle may be reaching for. When I was a younger man, I learned a very hard lesson doing that month after month after month, of knowing where it's likely to go, but growing in my trust to get to the point where I can say, okay, I'm going to leave something on. And how do you do that? Take as much as you can off and leave the smallest portion you can leave on a trade open until it hits it or stops you out. That's the way you get to that trusting factor. How do you get through learning how to hold on to these trades to get to these targets, ICT? Because if I was up a little bit here, my mind would say to me, let me get out of this because it's uncomfortable and I'm scared it's going to turn into a losing trade. How do you get through that? You get through it by holding on to it. You put your stop in a position where preferably it doesn't gap up above your entry, and that can always be a risk. Every one of these markets can do that. So in that regard, stop losses won't work. But barring those instances, your stop loss moved into a position where if it moves up to you and before you entered, or better than where you entered, in other words, if you were short, your stop loss is below your entry, you are sitting in that position there and you have the smallest position open and you hold for it to hit your target and you don't trail your stop loss anymore. You just let it go. And you grow in confidence over months and years, folks. It takes years. These yahoos out there trying to tell you you can learn this stuff in a couple of months or a couple of weeks or a 1 week boot camp are full of shit. Okay. You can't. You cannot teach somebody how to get a 200 to 1 fucking trade, okay, in a 1 week fucking boot camp. And they're teaching you trading and they're only showing nano lots in their fucking live accounts. Get the fuck out of here. But you're reviewing that weekly candle analysis and referring to that economic calendar. So that way you know the stage is set and you're looking for something opposite to what you anticipate in terms of directional bias on that weekly chart. So in an example, say you are looking at the pound dollar for Forex traders, okay? Oh, he's talking about Forex. Oh, yeah. I've been tired of hearing about this S&P shit. Come on, ICT. Come on back home to Forex. Actually, I am home with commodities, but nonetheless, say you're interested in pound dollar and you think that the weekly candle is going to expand higher based on your analysis on the weekend before the markets even open up. You think that there's reason for that weekly candle to go higher because it's been going higher and it's likely to go up to a specific old high or trade into an imbalance, a SIBI, or a fair value gap that's above price. Okay, I'll differentiate between SIBI and BISI before I close this, because I know some of you are probably chomping at the bit to dial in on ICT on the wire here and ask me what's the difference between the fair value gap, BISI, and the SIBI, and could you tell us the difference? And I will. Just give me a second, maybe longer than a second. But once you have that weekly and analysis and that calendar lined up, you now have a stage set for British pound likely to go higher. So you're in a buy model. And then there's a report coming out in the morning for pound as a currency. What you want to see is there a low on the 15-minute candle where sell side liquidity will be resting? Or if that low is really far away from market price, what is that? Well, it's relative to what your understanding about price is. There's no way for me to say it can only be this many pips. That's that gray area that experience is going to dictate. But if it's within, I don't know, 40 pips, anything more than 40 pips, I think is a much more meaningful move. And it's probably not a run for liquidity. It's probably going to just keep on going. But don't use it as a hard rule all the time. It's just a general rule or general principle that you can go by. And why do I use that? If you've studied my concepts with the Judah swing in London, where the London session usually creates the high or low of the day, it has a 70% likelihood of creating the high or low of the day. If you are in a sell model, and if you are in a seasonal tendency that's bearish, and it's an obvious draw on liquidity for sell side, all those factors being equal, then you do have a 70% likelihood. Because I see all these guys out there trying to run reports and statistics. ICT said 70%, and it's really not. I can see it's here that there's things that you didn't include. I just gave them to you right now. So go crunch your numbers. But those factors of looking for about 40 pips maximum is based on several things. And this is where you should be writing things down, folks, because if you're just driving down the road, chewing on your bubble gum and corn chips and shit, that ain't going to be good. You're going to have to come back and listen to this and write down some notes. Generally, from the open at midnight to the high of the day, it's usually within 30 pips that it makes the high of the day. Sometimes, in some weird instances, it'll go as much as 40 pips. Why 40? Because sometimes you'll cross and breach a big figure number, for instance, a 0-0 level. Okay. And if that's the case, the algorithm can many times spool or spread beyond a particular level, run past it, in other words, as much as 40 points or 40 pips. So that's why I use 40 pips as a general rule. And if it goes beyond 40 pips, then it's probably not going to be a sell-off. It's probably going to keep going higher. Or it means I need to sit on my hands and do shit. Nothing. Just go back to bed. And then I'll trade the New York session. Okay, so I just tossed it in there, no extra charge. But using our example for pound dollar in the New York session, if we are expecting something bullish, our weekly analysis indicates that we're in a buy model. There's a high impact or medium impact news driver coming out at 8:30 or so in the New York session, all New York local time. Everything is always New York local time. Stop trying to take your shit in your chart and line up to your local time because it makes sense to you. Everything in these markets are always going to be on Eastern time. I don't give a fuck who tells you different. I don't care how long they said they've been trading. I don't give a fuck. Okay. That's all bullshit. Everything, all these algorithms is doing is running on New York time. Midnight in New York, that's the beginning of your fucking day. It's not Wellington. It's not Asia. Okay. It's New York midnight. That's the opening. Okay. I don't give a fuck. Anybody tells you different. That's the way it is. And you bring them, if you're here listening, you bring your shit and I will run right with you and I will run fucking circles around you and show you exactly what these fucking markets do. But you're going to fucking be schooled. So don't talk your shit in your little private little circles, okay, your little fucking webinars, talking all your bullshit because you ain't getting the balls to come here directly. You do it right here and I will run circles around your motherfucking Mickey Mouse ass. Clown. UK boy.